Let's keep on this sector here and welcome in the CEO of Prosper Trading Academy, Mr. Scott Bauer, to join us. So we're going to, talk a little bit about these names a little bit more here with Scott, and we'll also look at a couple trade illustrations as well. First off, Scott, thanks as always for joining us here on the TD Ameritrade Network.
Thanks,
and a long time no see, my friend. How are things been?
I know. Things are awesome. I wish we could see each other in person again. I kind of long for the days of just going cross town and coming into the studio with you. But you're looking great.
Well, I appreciate that. And yeah, and in the future, we'll hopefully get things back to a more normal situation. But for now, hey, things have been okay. Let's talk a little bit about these. We're looking at both GM and Tesla. Let's start with GM. And from your notes, it looks like you have been involved in this one for at least a little bit of time. Talk to us a little bit about kind of the thought behind that. And then you also supplied us here with an example for maybe those who are involved or want to increase that position, or maybe you're just looking to get involved for the first time.
Yeah, so, GM had been a laggard for so long, and really until, as you and Michael just were talking about, the EV space is obviously the rage right now, and how much of that is helping GM, how much of that is prospect moving forward. And I think GM just has so much room to run on the upside. I love this. What they have done over the last few years, kind of transforming their entire model of basically 100 years, of this company. I think they've done an amazing job. So as you mentioned, full disclosure, we are in a long December call spread that we've had on. So full disclosure here. But in addition to that, there's a position, or there's a trade out there that I really like. And so what I'm looking at doing is selling the January 57.5, 52.5 put spread. It's going out a couple months. You can do that for somewhere between $1.50, $1.75 or so. The reason I like that, Alex, is because if GM pulls back at all, that 55 to 56 area or so, to me, that's a huge buy area. So if we pull back there, I'd want to own the stock out right there anyway. And that's, really the area where this trade breaks even. So that's why I like selling that put spread.
And it looks like from a risk-reward standpoint, Scott, it's about 1/3 the width of the strikes here. So $5 wide spread, collecting about 1/3 of that. And so doing some kind of back-of-the-envelope math and using some of that trader insight, that means we got on this one somewhere around, let's say, a 2/3 probability of success is typically how that's thought of. When you're looking at a kind of strategy construction and how things complement, that very much could complement an existing long position as it adds some deltas, but it gives the position a little bit of room. You're kind of buying into it more as it goes down. Scott, is that why you approach it with this style strategy? Is given its run up recently, you could see a near-term pullback, and as you mentioned, that 55 level seems to be interesting?
That's exactly right, Alex. It's giving it some room. And the real big thing about this one is that 55, 56 area. If the stock pulls back there, I'm a buyer of that stock in that range anyway. So this allows me to collect some premium against the other positions I have, or if you're just starting out with a new position, just collect some premium here. If the stock does kind of gradually, get down there, fine, we'll manage it. But I really love the reward to risk on this. And I think, again, that 55, 56 area, that's a pretty powerful spot for GM.
Good stuff. One that's been very much in the center of the conversation, of course, has been Tesla. So we can't leave that one off to the side without talking about it a little bit here, Scott. First, some insights around trading maybe a name that trades with the level of volatility and craze and excitement of a name like Tesla. And then let's talk about the example trade that you have.
Sure. And what people really need to understand is volatility is a good thing. And traders, experienced traders, take advantage of volatility, and it's not something to be afraid of. So I'm actually looking after this, the big moves that we have seen here, both to the downside, to the upside. I think this is set up to kind of coil a little bit. What do I mean by that? I think we consolidate in Tesla for a short while here. What's a short while? A couple days, maybe going into next week. That's what the charts are looking at here. So I want to take advantage of that. And I want to take advantage of the option prices being so expensive from that volatility that we've seen. So one great way to do that, completely risk defined, is by selling an iron condor. What that is I'm selling next week 1020, 10-10 put spread, and at the same time, selling next week's 11-30, 11-40 call spread, selling a put spread to the downside, selling a call spread to the upside. I can collect a huge premium for that, somewhere in the range of $5 to $6. You know, Tesla's moving all around. That is a huge premium. Even on a blowout move, down or up, the most this can ever be worth is $10, no matter what. So I've got my risk completely defined. My chances of keeping a good portion of this premium, in my opinion, are very high.
It's a really interesting way to approach it, particularly when you've seen a name like Tesla. Obviously, volatilities at times have gotten elevated relative to its kind of normal volatility levels just simply because of the realized volatility that we've seen. Undoubtedly, Tesla has made some big moves over the past week and a half or so, and that's caused implied volatilities to move higher. And so this is a trade that looks to capitalize on those elevated implied volatilities. Risk reward is much more in the 1-to-1 camp. And also, Scott, I think it's interesting as well that you keep the duration fairly tight here, because given the nature of the movement here in Tesla, you know, these options, while they may have elevated volatilities, really haven't decayed all that significantly because they're moving around so much. You don't know, like, you know, everything's got such a realistic possibility of being in the money, being a probability of a touch, that this is one of those things where time is likely to be the only catalyst to bring these premiums down.
There's no question. And Alex, you make up such a great point, bring up such a great point here. And that's the nature of all the Greeks that you guys talk about all the time of option pricing, delta, vega, theta. And you're right. There's not going to be a lot of theta in this trade until we get maybe to next Wednesday or so, just a couple days before expiration. So there's a lot of premium in there right now, a lot of premium to capture. Again, completely risk defined.
And that's the important takeaway, Scott, as always, is that you know the risk going in, you're aware of that going in, and I always say risk is controlled at order entry. You can keep that size in check. You can decide if it's a position that meets that risk parameter of the individual investor before hitting send on anything, and that way it allows for the decision-making to be one that's made with potentially a level head as opposed to an emotional-based decision-making. But hey, Scott, we got to run. Always a pleasure to catch up. Really appreciate you taking the time and providing some of that insight and example trades both on GM and Tesla. The CEO of Prosper Trading Academy, Scott Bauer.